Inflation's influence on stocks, direct and indirect effects. Inflation can have both direct and indirect effects on the stock market. Here are some of the ways in which inflation can impact stock prices and market behavior. Discount rates and interest rates. Inflation erodes the purchasing power of money over time. As inflation rises, the real value of future cash flows decreases. To compensate for this, investors may demand higher interest rates, which can lead to an increase in overall interest rates in the economy. Higher interest rates can make fixed-income investments like bonds more attractive relative to stocks, causing some investors to shift their investments away from the stock market. Earnings and profit margins. Inflation can impact a company's costs and revenues. Companies may face higher costs for raw materials, labor, and other inputs, which can squeeze profit margins. However, some companies may also be able to pass on higher costs to consumers through price increases, potentially maintaining or even improving their profit margins. The impact on individual companies and sectors will vary. Consumer spending. Inflation can affect consumer purchasing power. If inflation is high and consumers' real incomes are shrinking, it can lead to reduced consumer spending, which can hurt the revenues and profits of companies in various sectors. This, in turn, can influence stock prices, especially for companies that rely heavily on consumer spending. Central bank response. Central banks often respond to high inflation by raising interest rates to control it. These rate hikes can impact borrowing costs for companies and consumers, potentially slowing economic growth and affecting corporate profitability. When central banks signal tighter monetary policy, it can lead to a negative sentiment in the stock market. Asset allocation. High inflation can lead investors to reconsider their asset allocation. Some may opt for investments that are considered hedges against inflation, such as commodities or real estate, potentially reducing their exposure to stocks. Earnings expectations. Investors often base their stock valuations on earnings expectations. If inflation leads to uncertainty about future earnings due to volatile input costs, it can make it more challenging to predict a company's future earnings, which can lead to increased stock price volatility. Valuation metrics. High inflation can impact traditional valuation metrics like the price-to-earnings (P/E) ratio. As inflation rises, the real value of future earnings may decrease, leading to higher P/E ratios if stock prices do not adjust downward accordingly. This can make stocks appear more expensive by historical standards. It's important to note that the relationship between inflation and the stock market is complex and can be influenced by various economic factors and market conditions. Additionally, the impact of inflation on stocks can vary over different timeframes. Investors and analysts closely monitor inflation data and central bank policies to assess potential market impacts and make informed investment decisions. For more videos like this, please subscribe to my YouTube channel Investor Affairs.